Hey guys, and welcome back to Inside Investing, and today we're going to be showing you the power of compound interest, because what we're going to show you today is how much money you can earn if you invest different amounts of money. And at the end of this video we can also show you how to calculate the amount of money that you can possibly earn if you're investing into the stock market. So please watch until the end, because there you will see how you can also calculate that. And overall, what this comes down to is the power of compound interest. So that's what we're going to show you today right here in this video. So please subscribe if you haven't done so already. Give this video a thumbs up. Also comment down below if there's any other questions that you might have. This is also one of the questions we got from a subscriber actually. So definitely a big shout out to you. And let's dive right into it. So we see initial deposit. That's of course the first part, right? So I want to start investing today and I've got a few €100 laying around. I want to start investing that money. So that's the initial deposit. What can I deposit right away today when I want to start investing? So this is the initial deposit. We've got a monthly contribution. So that's the money that I'm going to be investing on a monthly basis into my investment account. So 12 times a year, on let's say every time the first of the month, I'm going to be investing this monthly contribution. Then we've got an investment time span that you need to decide on. So that's the time that you want to invest overall in, right? You want to calculate how much money will I have at the end of a specific period. And well, that period we can see right there. And then the estimated rate of return. We can also show you today during this video how you can see or at least estimate what the rate of return might be. So in our first case example, we said the initial deposit is €1,000 or $1,000 in this case. So in this case, we say we've got $1,000 that we can directly invest into our broker account, into our investment account. Then the monthly contribution is going to be $100. So every month I'm going to be investing $100 in my account. Every first of the month, let's say, investing $100. This is then in total on an annual basis going to be $1,200, right guys? The time span is going to be 10 years. That's, I would say, for long-term investing, not too long actually. I think I'd rather have this at around 20 or 30 years, but for a first example, let's say 10 years. And then the estimated rate of return, we keep it at 8%. So we say on an annual basis, we're gonna be getting 8% more money. Then let's have a look at the money that we've earned. So we see again on top of the screen the same exact numbers. Then we see the total principal of $13,000. And the total interest. So the principal is the money that I've actually invested into my account. So this is the money in 10 years I would have invested $13,000. And the interest, so this is the money that I would have gained just by investing my money. So in this case, the future balance after 10 years of investing would be $19,559, which is, I would say, already quite okay. Of course, it's not the money that we're dreaming of, but I think that comes from a few things. I think honestly the rate of return is a very I would say fair estimation. Around 8% should be possible on an annual basis. The initial deposit is also quite fine. I would say the monthly contribution is okay. If you could, let's say, tweak this up a little bit, would be even better, of course. And I would say indeed the time span is a bit short. 10 years is not too long to invest, but we'll see that also in the next case. But at least we see that, yeah, we would already have around 50% increase of our money, right? So we would have invested $13,000 and we would have gained around $6,500. So that's already in 10 years just by investing in a very easy way, right? We're not spending too much money. This is also without very much emotion. We're not checking the stock prices on a daily basis. We're not checking the news for a specific company on a daily basis. No, the only thing that we're doing is just every first of the month investing the $100, as you see right there, into our broker account. And then in 10 years, this would be our result, around $19,500 with total invested around $13,000. But let's go to the next case, because in this case, we say, well, the initial deposit is exactly the same, but here the monthly contribution is a little bit bigger. So every month we are investing $300 into our broker account. So $300 instead of previously the $100. But also, this is also quite a significant longer time span, guys. We see that that's around 20 years. So we say this is around 20 years. So let's say you start investing if you're 25. Let's say you're 25. Yeah, this would mean that at 45 you want to stop investing. So this is then any 20 years of your life. Already quite a significant period. And now, guys, let's see how that would turn out into a broker account. That's a future balance of around 170, I would say, around 170,000 US dollars, with a total principal of around $73,000. So we would have invested $73,000. That's quite a lot of money, but again, it's only $300 a month. So it's not too much money that it's not like you're investing I would say thousands of dollars every month. No, it's $300. Still quite some money, of course, but I think something that quite a few of us should be able to figure out a way to invest this. But then we see here, and now stuff gets funny. We see that the interest is around 100,000 US dollars, so $96,500 actually. So that's a lot of money that we would have earned in this case. And it's actually more than we've invested in. And that's the biggest cause here is the time span. So it's just the 20 years. If you are able to invest in a longer period, over a longer period, then you would see that indeed the interest would, go over the principal. So you would get more money out of it than you've put into it, just because of the time that you invested in the market. That's also why we also say it's time in the market, not timing the market. So we're not going to be saying, well, I need to wait until the share price is a bit lower. No, we just say buy it each and every month. And in our case, a heavy focus on ETFs, specifically on S&P 500 and VWRL. If you're interested in that, by the way, then definitely subscribe. We do quite regular portfolio updates, so you can always figure out how our portfolio is doing, where you can also see how the S&P 500 is doing and a sneak peek. We can say it's doing quite well, but VWRL is currently doing even a little bit better, with around 15% even, a little bit higher perhaps. So it's going very well currently. But that aside, for now at least, we can see that about $170,000 would be the future balance in 20 years. If we have an initial deposit of $1,000, $300 each and every month invested. A very good amount of money we should have been able to earn in, I would say 20 years is also not too long of a life of a time span. I think you need like 40 years would be a little bit, then you need to start very early. It's still fine, right? If you're 25, you invest 40 years, that means that you're 65, which is, I think, on average the time that we preferably want to stop working. So that should even be possible, and then you would see that these numbers are even more crazy. But at least this is something to very much look out for, and that's also why we say you need to start investing now, because the sooner you start investing, the higher your results and your profits are going to be. So definitely start investing as soon as possible, and of course do your own research. That's always important to note there as well. So let's see, we've also put in a graph with a few other examples as well. So let's see, we've got, this is exactly the same. So the initial deposit in these three cases are exactly the same. We've got $100 investment, the contribution per month, and then 300 and 300. But then we see 10, 20, and 30 years. Ooh la 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 la, guys. You see that there's a lot of money to be made if you just have 10 years in addition. So if you are able to invest for 30 years, you would have more than doubled the amount of money. Yeah, tripled actually the amount of money that you would earn with your investments. So instead of 96,500, you would have gained 309,000 US dollars, with again an estimated rate of return of around 8%. If you wait a second, in a few seconds I'll also show how you can find out the estimated rate of return. So you can also for yourself calculate, okay, how long do you want to invest? How much money are you able to contribute? What has been your initial deposit? And then you can also see how much money potentially you can make. Of course, it's an estimation, but still it's very nice to at least see for yourself what you're working towards. In this case, we see that a little bit of a smaller period. So we go back to the 20 years, but then a bigger monthly contribution, around $500. We still get around 286,000 US dollars, with again $163,000 of interest, so of money earned by investing in the stock market. And then the last example is a 30-year time span. Again, quite a long period, of course, we know. And then also $500 US contribution is quite significant on a monthly basis. But if you were able to put in this much money in your investment account, then you can see that it's getting close to $1 million mark, guys. It's around $730,000 US that you can earn in this way. So that's very significant. I think for now we've at least marked these two examples, because I think these overall should be possible for most people. So around $300 invested, starting off with around $1,000 US as your initial deposit, and then a time span between 20 or 30 years. Yeah, you see, the sooner you start, the better it is, guys. If you start today, then you at least have a few extra days, few extra years in the pocket, and that you can be in the market for a longer period. And right here you can see very significant the difference in your bank account eventually, because instead of 96,500, it's going to be $309,000. So that's a lot more money to be made. So guys, if you haven't done so already, then please subscribe. It helps out the channel grow a lot, of course. Also, if you haven't given this video a thumbs up, please give this video a thumbs up. It helps out us grow as well. As I mentioned before, we do a lot of portfolio updates where you can actually see how our portfolio is doing. And for that, we use DEGIRO, of course. So if you also want to start investing, then please use the link down in the description. And as I promised, I'm quickly gonna pull up how you can also calculate this for yourself. So in this case, let's say you're mainly investing in the S&P 500. I've just Googled, very easy, just Googled annual returns, S&P 500 average. Google is already saying around 10%. Then we quickly look at the first few results. What do we see? Returning of 13.6. I think that's a bit much. 13.9 annually. Average stock market return is about 10%. Yeah, so I think if we say 8 or 9%, that's a little bit on the low side, but that should be fine. And then in this case, we go to smartasset.com, but there's a lot of different calculators as well. So please use the one that you like to use, of course. And then right here, we can see, and we can actually enter everything that you want to enter for yourself as well. So let's say you've got a little bit more money on hand, so you're able to directly invest $5,000. And indeed, you're able to invest also a little bit more, so around $250, but not per month, or sorry, not per year, but per month. Then we do it like this, and then we say, yeah, an annual return. Yeah, we can put it on 8, as you saw also in what I just quickly Googled for you. I mean, it could be a little bit more, it could be around 10%, but let's keep it on the low for now. Let's keep it on 8, that should be fine. But let's say that you're indeed like 20 years old, then you're at least able to invest for 35 years. And then, oh, that's a pity. The maximum value is 30. Still fine. If we put in 30, that's a lot of money. Our portfolio will be worth around $427,000. And also here you can see the big difference in our contribution versus the interest earned. So we've invested, as you can see right there, total contributions is around $90,000, but we've earned $332,000. So that's a big difference in the money that we've invested versus the money that we get out of the market. And this is based upon an average of 8%, which is indeed based upon the last, I would say, last 60, 80 years, what the S&P 500 is capable of performing. So we see how little we've actually contributed in comparison with the money that we've gained. And that's, I think, mainly because of the time span. 30 years is quite long. And then you can see $427,000. So guys, hopefully this helps. If it did, then please give this video a thumbs up. Also leave your comments down below in the comment section. Also, if you want us to calculate it for you, definitely leave it down below, and then we can also do that during the next video. So guys, thanks for watching, and we'll see you in the next one. Let's go.